The stock market is falling, but not for the reason you think. This is pressure building inside the system, and most people don't even see it happening. Right now, global markets are reacting to rising tensions between Iran and the United States. Oil prices are climbing, supply chains are starting to crack, and suddenly, stocks stop behaving the way people expect, not because investors are emotional, but because the system itself is under stress. Let's break this down simply. Oil prices are moving toward $100 per barrel, and that matters more than you think, because nearly 20% of the world's oil supply passes through one narrow route, the Strait of Hormuz. If that gets disrupted, the entire global economy feels it, and we're already seeing early signals. Markets around the world are showing pressure, some reacting mildly, others reacting sharply. Because this isn't random movement, this is a chain reaction, already in motion. Here's how it actually works. When war affects oil, oil becomes expensive. And when oil becomes expensive, everything becomes expensive. Transport costs rise, food prices increase, factories pay more to produce the same goods. And when costs rise, profits shrink. And when profits shrink, stock prices follow. This is not emotion. This is cause and effect. And that's exactly what you're seeing right now. Airline stocks are falling, fuel costs are crushing margins. Consumer companies are struggling because they can't raise prices fast enough. Tech stocks are becoming unstable because uncertainty kills confidence. But energy companies? They're rising because higher oil prices mean higher profits. In fact, some oil companies are making billions more during this exact situation. Same world event, completely different outcomes. Now here's where most people get it wrong. The market doesn't crash because of bad news. It crashes because of uncertainty. Because investors don't know what happens next. Will oil hit 120? Will supply break down? Will inflation spike again? And when people don't have answers, they don't wait. They exit. They sell. But here's the twist. Even during all this tension, the S&P 500 is still near record highs. So what does that tell you? This is not a collapse. This is volatility. And there's a big difference. Every crisis creates two types of investors. Those who react and those who understand. As a result, it is essential to recognize that historically, markets tend to face a downturn as uncertainty increases. However, they manage to bounce back when clarity resumes its presence. And this pattern serves as a recurring reminder each and every time. So, what exactly should you do at this very moment? Do not panic, for starters. Do not chase sensational headlines. And definitely do not assume that everything is gravely falling apart. Fact is, the market isn't necessarily reacting to today. Instead, it is calibrating itself to the potential outcomes that could transpire next. Yes, we should acknowledge that wars may significantly contribute to inflation. They might push up energy prices and create substantial pressure on interest rates. However, they also present ample opportunities. Shifts in sectors, temporary mispricing, and long-term entry points are just a few of the instances where great financial rewards can be found. The fact remains that you don't have any control over warfare, oil prices, or global markets. On the contrary, you possess the power to control your own reactivity. Should this provide you with a sense of clarity, subscribe to our newsletter, because the opportunities that lie in the realm of money are most evident when most people are simply confused.